if I go to the S&P chart, you can see that, something we talked about a lot lately. First of all, this is a fantastic uptrend in the S&P. It really begins when the expectation for QE2 begins. This is where the rumblings, the rumors begin back here. The market just takes off. And this is the S&P 500 is represented by an ETF called the Spiders, SPY, right? And we had a very sharp pullback, hit the 100-day moving average. And now we've popped very nicely off of that. But if you look at this area up here, look how small the candles are getting. In other words, this move appears to be exhausted. You're into a resistance area up here, right? And look at the little spinning tops and all the various little small bodies, which is telling you that this move appears to be exhausted. Additionally, there's a gap here. There's a gap here from last week that hasn't been filled yet. And we know that very often gaps get filled. Why? Because sometimes orders are resting in there that need to be filled. And therefore, it is advantageous. It is preferable for the brokers and the banks if all the gaps are filled, because that means there are no orders sitting out here unfilled. And, the banks and the brokers, they make money when the orders get filled. That's just a fact of life. They can't control the market. Sometimes gaps don't fill. It doesn't always fill, but I think when you do see a gap, I think there's a high probability that it will fill at some point. So that means this market would have to come down in order to fill that. Why do we look at the S&P 500? We look at a lot of things because they're interrelated, right? The rally in S&P 500 doesn't look terribly different from the rally in Euro, right, on the daily chart. And, they both took off, and they've both had tremendous runs recently. Just watching the pullback here, we talked about 142.50 as an area. Right now we're trading at 142.60, and we got as low as 142.42. So we got maybe 8 pips below that area. Again, it's not something that I would dive into just as he's beginning to speak. But of course, Trichet has been going on for an hour now. And the takeaway from Trichet is, of course, and let's go to the 5-minute here. The takeaway from Trichet is that he will not commit to greater rate hikes in the future. He's not committing. He didn't use the word vigilance. One of the questioners tried to lead him, putting vigilance in his question. I believe it was a questioner from CNN. Trichet didn't bite. He said, we haven't decided. He's not saying one way or the other, but he just said, we haven't decided that this is the first in a series that has not been decided. So the market's a little bit disappointed. Didn't hear vigilance. Didn't hear any commitment to future hikes. But one thing that I did hear from Trichet that I found interesting, and in fact I tweeted it, I found it so interesting, is that Trichet said that keeping inflation, and I'm just going to paraphrase here, if you don't anchor expectations of inflation, you're going to hurt growth. This is huge in my mind because it really sets him up. He's diametrically opposed to Bernanke. Bernanke is creating expectations of higher inflation and trying to use that to create growth. And Trichet is basically saying the exact opposite. Trichet is saying by creating expectation of higher inflation down the road, you hurt growth. It's like threatening the market. It's like threatening business with a tax. You hurt growth when you do that. And that's exactly what I think Bernanke is doing. So really, Trichet, in my opinion, is on the right side of that issue, and Bernanke not so much.